Welcome to our number 2 in our series of costing and pricing, the second of the 3 videos. In this one is actually looking more on the lines of in a retail scenario of getting an indication of the sort of number of sales that you would need to make a week. So the way we're looking at working that out in a very simple format is taking into consideration firstly what your income you want to have as your income. In this scenario, I've used something like $75,000 a year as a taxable income. Everybody has their own idea of what they want to earn, so that box is going to be certainly up to you to put in your own figure of what you're expecting to go for, to be earning. Next is the fixed overheads. We're put $150,000 in for this scenario. We're looking at the overheads of including everything that you need to that costs you to operate that business: wages, rent, insurances, your equipment. Don't include any of your stock or goods in this scenario, because it's this is working on purely how to make sure you're going to cover your expenses in your costing. We also need to have profit, a profit line. So many people leave the profit line out. Now, if you're with $75,000 as your income, if you looked at that being protected and non-negotiable, that's what you're looking at having. If anything goes wrong, or you're looking at increasing any activity or to go towards growth within your business, you need to have a profit line. I've put $20,000 in for this exercise. Now, if at the end of the financial year you've got the $20,000 sitting in the bank, that would, and you're a sole trader or a partnership, that would become $95,000 as your taxable income, unless through probably good communication with your accountant that you determine whether you should be spending that in another area to utilise it before they actually work out your tax for that year. So overall, for this scenario, we've got the total expenses seen as being $245,000 for the year. With the $245,000, anticipating in most retail type environments, you'll likely be open 52 weeks in a year. Now, you may want to weigh this slightly differently depending on your individual business. But for this scenario, we've worked on 52 weeks of the year, divided into the $245,000, leaves us $4,710 per week you need to turn over as expenses to cover your expenses. So that's not including the actual cost of your goods, product, and so on. So using the theory of a 100% markup, and anticipating that in this scenario the average sale is going to be $20 per sale, means that 50% of the average sale would mean $10 out of the 20, means divided into the $4,710 per week is 471 sales per week that you would need to be making to equal this scenario. So your cost of your goods and all those sort of things are on top of that, of course, again. But this is working on the markup amount that the markup ratio or percentage that you're looking at being 50% of your overall sale price. Then that's the equation in this instance. So that gives you an idea of the number of sales you have come through the door. Is that viable? That's up to you to determine, and depends on how many hours a week you're open and what sort of products you're selling. To get a better understanding of how this may equate to your business, by all means come and see John and myself. John's certainly experienced more so in the retail than myself, but we can both help you overall with with any of your scenarios that you may have within the retail business. See you next video.